Welcome on into today's video. We're talking technical analysis for beginners. This is going to be a great starting block, a great place to come if you are someone who is brand new to technical analysis and you want to learn what this is and then how you can utilize it, start doing your own analysis on your own charts for your own trading and investing, or if you're someone who has some experience but wants to get a better feel, this is the video for you. 100% free. We're going to cover a lot of stuff in today's video, so stick with us. It might be a little bit long, but we'll have some timestamps down below. First things first, we are looking at a stock chart, okay? This is Apple, and we are using a platform called TradingView. If you guys are familiar, great. If you're not familiar, we'll leave a link to TradingView in the description box down below. The reason why we say that is because you need a place to be able to do the analysis in the first place. You can start to get to a point one day where you're looking at charts and you can look at those line charts on CNBC and get a pretty good feel. But we want to look at candlestick charts for the most part. You don't have to, but for the most part, we'll look at candlestick charts for these videos. And then we want a place that we can look at these things at our own lines, do our own analysis, draw in what we want to draw in, whatever we got to do, draw in our zones, draw in our boxes, all this stuff. Like, we want to be able to do that on a platform or in, one spot that we can refer back to and utilize this, whether we're trading on this specific platform or not. We need a home base to do our analysis, okay? So, highly recommend something like TradingView. We pay for the premium version here. You don't have to pay for it. There's free versions. There's also free trials for like 30 days if you ever want to check it out and see what you're potentially missing out on if you don't have a paid version, but you don't have to pay for that. Your broker probably will have what you need. Okay, so we're organizing this video into like 7 parts, and the 7 parts are as follows. The first part of this video, we want to start with kind of how we want to look at things, right? How should we be framing our technical analysis? And we'll give you a way to go about it. Of course, all of what we say in this video can be and should be customized. There is not one way to do anything, especially in the world of trading. Everybody has different eyes. Everyone has different ways to interpret things, which is awesome. But what I see, you may not see, and what works for me may not work for you. So what we talk about, and we'll issue some caveats here, but what we talk about should be taken with a grain of salt, but also feel free to be creative with it. That's the whole cool part about trading, is that you can do whatever you want. You're not confined to specific rules that you don't set. You set your own rules, and you get to go with it. Now, of course, you have to be careful because you can get yourself into a pretty tough situation if you set rules that you're not respecting, but that's what it's all about at the end of the day. So from there, getting a big overview, we're going to go from like a how to look at things approach to understanding direction, trending versus not trending. Okay, we'll understand how that works and how we can identify that pretty easily. Then in terms of that, we'll look at non-trending markets, and then we'll look at trending markets, and we'll be able to identify trend lines, channels, support, resistance, key levels. How do we identify them? What are we looking for? Okay. Then after that, we'll talk supply and demand, which is one of the bigger aspects of, I think, trading, because using supply and demand, you're going to find that it's going to cut out a lot of the errors you're making with just support resistance. Although still useful, supply and demand is a better way to look at support and resistance. Then on top of that, we're going to talk patterns. What are some patterns to look for? Bullish versus bearish patterns. And then after that, to wrap things up, we'll talk trading plans. And so when I say trading plans, we'll actually apply this stuff that we're talking about to actually making trades and how one may go about trading a specific stock based on their technical analysis, okay? So, lots to unpack. We're going to take it nice and easy and get us through. I traditionally have had problems in the past going too fast. So if you have to increase the speed of the video, which to be honest would be pretty impressive if you did, go ahead and do so. But I don't want to make it too fast, as I've had a lot of people say, you talk too fast, can't understand you. So we're going to try to keep it nice and calm today. So we're looking at Apple. First things first, we're going to talk about how we want to look at things, or a way to look at things. And we're going to start with a top-down approach. And this is one of the ways I love to do my technical analysis as someone who primarily starts here and then goes into more depth in terms of figuring out what trades are valid and what's not valid, and what setups present themselves with a good risk reward that fit what I like to trade. So I start top down. You can go bottom up it just depends on your time frame and what you're looking at. So if I'm looking at a stock like Apple in this case, and I'm like, okay, well, I might want to trade Apple next week. They got, pretty liquid option contracts, tons of shares, tons of volume. There's no problem getting in and out of Apple, whether I want to trade shares or I want to trade options. So I might look at Apple as a stock that, might be a stock of interest, right? Or what I like to do is, to be honest, have a list of your go-tos, and Apple might be on that list of go-tos of stocks that you're very familiar with. You see all the time, you watch how they trade, and you've got a good feel, for at least what you're looking for on Apple. But even if I'm going to take a day trade on Apple potentially this week, and it's over the weekend, we're sitting here one night just kind of checking out or going through a watch list, trying to figure out what we want to do. Even if that's the case, and I might be trading off the 1 minute, which I don't, but maybe I'm off the 5 minute, the 15 minute, even the 1 hour chart, I still need to see what's Apple been doing lately. What is the daily chart? What's the weekly chart? What's the overall big picture trend? So I go from a top-down approach and I zoom out and I get a picture of the trends and then I zoom in. What do I see right now on Apple? As I zoom this chart out, I'm noticing Apple actually just hit down to the lowest point that it's traded this entire year, the past 12 plus months. Apple hit the lowest point, bounced a little bit, but it's right there. So it's teetering on the brink of potentially the next leg down or a bigger move to the downside if it was to undercut these lows substantially, as we've seen this past year. Apple's done a couple of times. Every time it undercuts the lows, it undercuts them by a couple bucks at least, and sometimes more than others. And so we undercut by a few dollars, but I'm very interested to see if this area was to hold and we bounce back up, or if not, we could easily sell off a bit more and potentially undercut the lows a bit further. And what we've seen is that when we do that, the moves get pretty sharp and they're pretty volatile. So maybe that gives me a really good frame of mind before I take a trade on Apple, knowing that if we do go down, it could be quick, it could be aggressive. And if we do bounce, these bounces could be aggressive as well. So when I'm in the trade, I need to respect my risk, because if I'm wrong, I could be wrong. And I could be wrong in the wrong direction very, very fast, and it could get out of hand if I don't have stops in place. So the big picture approach, the top-down approach, is how I like to start. So I zoom out, daily chart, past couple of months, past couple of years even sometimes, to get a frame of mind of where we're at, okay? Once I have that, I'll start to zoom in. I'll go to the past 6 months. I'll see, okay, what do we got the past 6 months? And as I zoom in, for example, we're looking at a 2-hour chart here. When we're looking at the 1 year, 1 day, we're not looking at extended hours. Right now, I have extended hours checked as an option to look at. So now I can see what happened, the gap ups, the gap downs. I can see the price action in pre-market and after hours. And so it kind of fills in some of those gaps that we see. All right, I got a good feel for what's been going on as of late. I want to zoom in further. I go to the past 1 month. This is now a 30-minute chart on Apple. And I can start to see. Now I go into the next zoom for me is 5. I don't go past 5 minutes, but I tend to utilize, these shorter term charts when I'm actually starting to plan my entries for the next day, potentially. So I'm noticing that, okay, Apple big picture, right, doesn't look great. But if we were to catch a bid and we were to have one of those aggressive bounces off of that new low of the year, because every time we have a new low of the year so far this year, at some point, Apple snaps back in a hurry. And so I don't want to be short when it snaps back really, really fast, right? So now I start looking at this. And I say to myself, okay, Apple's been putting in lower highs each day the past week or two. Here's lower highs, lower highs, lower highs. Now, if Apple starts to get up over this 130, up over this lower high, over this lower high, and then even up this one right here in the low 130s, that starts to invalidate some of the downside that I could be looking for. So I keep this in mind, okay? And I might look for entries at some point on the short side or even the long side if Apple was to get up here, put in a higher low and start to trend higher. That could be interesting to the upside. So big picture approach, we're going top down. Now we're going to dive into the patterns. We're going to cover a lot of this stuff here as we get going. But now you got a good frame of mind of how, you could go about thinking about this stuff. Of course, you might not care about the super big picture. You might be a scalper who only needs to look at candlestick patterns, very short-term patterns, and that's it. And that might be fine, okay? So this applies to any time frame when I do this approach. Doesn't really matter. It applies to all time frames as I start to do my analysis. Now, the second part, I want to understand direction. So like we were saying on Apple, if I zoom out on Apple's chart, but I start to zoom, these are now daily candlesticks, but I want to zoom in a little better to see it. I want to understand direction here, and I want to see, are we trending or are we just consolidating and not trending? Using TradingView, there's actually a really interesting indicator that we can use to give us a picture of this, and I think it's kind of cool. So what I'm going to do is I'm going to go to the indicators tab right here on TradingView. I'm going to go to where it says technicals, and then I'm going to go to the indicator called chop zone. Check this out. I think it's kind of cool. So what I'm looking at on this chop zone indicator is I can zoom this out, and at the bottom of my screen, kind of where like the RSI would go, or the MACD and whatnot. What it tells me is this green / this blue is going to be more so for uptrending environment. And then we have this yellow, which is like chop, and then we have red and downtrending. So I'll look at this to get a frame of mind for like what's happening right now. And are we kind of choppy? Are we downtrending? And right now, we are technically still downtrending. Eventually that will end, but we are still downtrending, and it's been a lot more red here than blue and greens and even yellows as of late. So it tells me that there's a lot of pressure. Sellers are kind of in control as of late on Apple. So I'm starting to get a sense of direction. Are we trending? This tells me yes. Of course, that can change like anything at any point, but we are trending to the downside, at least as of right now on Apple. And you don't need to use indicators for that stuff. And to be honest, I'm not a massive fan of indicators, because a lot of what indicators are going to do, and no indicator is perfect, no indicator is 100%, but a lot of what indicators are going to do is they're going to tell you something that you can probably already determine anyways by looking at the stock and by looking at the chart. And as you have experience looking at the stock and at the charts, you'll probably get a really good feel anyways as to like, oh, we're oversold. Like the RSI, I'm sure the RSI is in oversold territory. Yeah, like the stock's down a ton. Like, if I look at, for example, a Tesla, when I'm filming this video, TSLA, if you look at Tesla, I mean, I didn't need the RSI to tell me that we're oversold the past couple of days. We're oversold. We're down a lot. You zoom this chart out, the past couple of years, that's the biggest move to the downside, most aggressive move down we've seen on Tesla. Yeah, we're oversold. I don't need you to tell me on the RSI. I got it. Okay. And I know that just because we're oversold in the RSI does not mean we're going to bounce back today, this minute, next minute. So that's kind of my take on indicators. Some are more helpful than others, but they could be a good guide. Don't use them. They're not 100%. They're never going to be 100%. Okay. So let's pick a different stock. Let's go back to let's look at SPX, the S&P 500, baby. So I'm going to get rid of these lines so that you guys can get a fresh start. We get a fresh look at the S&P 500. And once we got a fresh look at the S&P 500, I can kind of do the exact same thing. Are we trending? On this big picture time frame, yes. It looks to me like we've got lower highs and we've got lower lows. That to me looks like a trend. So now we are trending. If we're not trending, or if we zoom the time frames in, you're going to find differences. And so far, maybe in, let's say, a range-bound market that looks like this, there are still going to be trends inside that range-bound market that you can take advantage of. So now, if I'm looking at the S&P, I know big picture, we're trending down, okay? And we're going to talk about the breaks of these trends and the opportunities and the potential setups that there could be that you can trade off of in just a little bit. But as I zoom this chart in to, let's say, the past 1 month and look at the past 30-minute or the 30-minute chart, as we say, what do I notice? I notice that we go from a trending market to a market that is no longer trending. It's a much more range-bound market. We've got a pretty tight range here. And we're just like in this consolidation zone, waiting for either a break to the upside or a break to the downside to give us that next sense of a direction. And so that's what's important to look at. If you are a swing trader, right, and you're looking at these big picture charts, the S&P is downtrending. And so you probably want to focus on shorts at highs or at relative highs or up into resistance, which we'll cover in a minute. And if you are maybe right now a short-term trader, I'm not going to have that bias of, oh, we're downtrending, that bias is not going to dictate my 5-minute chart trade. If I zoom in right here and I use that bias this past couple of sessions on the S&P, well, I might have been looking to go short because we were looking like we're breaking down towards those lows multiple times, and that bias would have had me wrong. Okay? So make sure when you are looking at things, you try to be as objective as possible, because one of the biggest problems that I've had, it still comes through, from time to time, is when you try to think that you know what's going to happen next, or you try to kind of put together what's going to happen next in your head, whether it's subconscious, whether you're watching CNBC, you're watching somebody on social media who's telling you we're going to do this and we're going to do that because of this, this, and this. Cool. You understand the arguments. You can make sense of that argument. It might happen, but there's no guarantees. And if you let that fall into your trading, you're going to get crushed. Trust me, you'll go through periods where it might work and you might be dialed in and you might have it down. And then when you go through those periods where it's not working, oh my, you can blow up fast, and it is not fun. So you got a good picture of, okay, we're trending versus we're not trending. How do you know? Well, we kind of have a good picture view, and they could be different time frames. There could be trending charts on the 1 year, 1 day, and then non-trending charts here on the 5-minute chart. Like, we are not trending here. There is no direction. Yeah, there's been smaller moves inside, but generally speaking, the past couple of days, the past like 10 days, 5 to 10 days here, we are just in a range, and that is what we've got. So that is going to dictate your trades, because if we've been range bound for a long time, eventually when we break that range, there could be a really big trade there. Okay, but if we're range bound and you are looking at this and the moves aren't that big, you got to make sure that your frame of mind is like, okay, I can't expect huge moves here until this range breaks. I got to expect short moves, take my, couple bucks here and there and move on, right? Take my small base hits and move on. No home runs, no home run shots, at this point in time. Okay. So in a non-trending market, which we have right here, I'm going to get rid of this VWAP for just 1 second so we can kind of see it a little bit cleaner, which we'll cover patterns and whatnot in a bit. Let's talk about this. First things first, I do want to mention that before we get into like patterns and support resistance and all that fun stuff, there's a recent video up on the channel already covering how to chart stocks for beginners. We cover some of the candlestick information in there. If you want to go back to that video, there should be a section timestamped that says candlesticks or something like that. That would be a great place to start. If you don't know what these candlesticks are, please, I would recommend starting there. So let's start with a range-bound environment. When we're in a range-bound environment, for example, like we're looking at right now, what we want to do is we want to draw a lot of horizontal support and resistance, okay? We'll cover supply and demand in just a minute after we get through these range-bound environments, drawing in your support, resistance, and your trend lines. Then we'll cover supply, demand, then we'll dive into patterns. So we are right now sitting in a range-bound environment. When we are looking for support and resistance, I want to use my horizontal trend line tools, essentially just a horizontal line. So on TradingView, it's this line right here, the horizontal line tool. I have a list of like my top tools that I use all the time, and I have them at the top of my screen, but you can find it on the left-hand side as well. So what am I looking to do? I am looking to utilize this tool to find levels on this chart from the past couple of sessions, and this could apply to any time frame, that I see a lot of candlesticks not falling below and not breaking above. Plain and simple. So what do I see? Right in the middle of my screen. Let me see if I can make it. Yeah, I guess because it was the S&P, with the SPX was kind of in the way. Right here now, towards the left of my screen, I notice like, wow, a lot of candles are struggling right here. So what I'm going to do is I'm going to draw a horizontal line roughly towards the top of that range. Now, you see how there's a bunch of wicks. Some of these candles get above, some don't quite. The fix to that is supply and demand. There is a very easy fix, and it's supply and demand. So stay tuned for that. We'll get there in just 1 second. On top of that, we also have this area right here that we got a bunch of rejections up there. And if I look to the lows and try to find some lows, not as clean for sure. But if I draw this line in right here that catches this low, it also catches this relative low right here. It even catches this low. There's some noise, and trading's not perfect. But what I have is I have 1, I have 2, and I have 3 areas of support, generally speaking, on this chart. Okay, and so I can catch a nice bunch of lows right there, and so that tells me that we've got an area of interest. Now that would be support, and the top end here would be resistance. Now, of course, there were moves a little bit higher, and there were moves a little bit lower. In this example, as we kind of didn't do much the days after, what these were called fake outs. These were fake outs. We broke the upper bound of the range and we broke the lower bound of the range, but then quickly found ourselves right back into the middle of the range that we had previously developed for like 2 or 3 days, really prior to that. So these were fake outs. And these can tend to happen from time to time, and they suck. I'll tell you that, but you have to be aware that that is part of the game, okay? So it's a lot easier to realize it after the fact, but during the situation, you need to make sure that you're trading with risk management in place when you're doing your technical analysis, so that if it's a fake out, okay, I lose, the trade's a loss, but it's not a blow up loss, right? It's a loss. That's part of the game. Fake outs are going to happen. You're going to be wrong, just like you're going to be right. So risk management, which we'll cover towards the end, is important here. But right now we've got a range bound environment. We can kind of identify support, resistance a bit, and we've identified some key levels. So now what we're looking for is, going into the next trading sessions is, a break up here and ideally a breakdown here. But what we want to see next is when we potentially have a retest, as they say, as a previous resistance turns into support and a previous support turns resistance. That's just how things generally work. Not all the time, but that's how this environment generally works. What now we're looking for is a retest. So what do I mean by a retest? So here's how we know that this trend or this range is gone and it broke. We were either going to break out, pull back into the top end of the range, and then push up from there even higher, eclipsing this level. That might be more, it could be up here, could be up here, could be down here. It doesn't matter really where it is. But you want to see the market or price action push above the top end of the range, pull back, and then go higher, right? That is like, okay, great, now we're out of the range. Same thing on the downside. Break down, pull back, or I guess bounce up, and then go lower, okay? That's what we're looking for a break of that range. Now, once we break that range, now we can talk about trending environments and trending markets. So here's the S&P. Let me get rid of all these lines. Here's the S&P. And let's just say that this is what the chart looks like on a zoomed in approach on the 5-minute. Doesn't matter that I'm looking at the one day, but let's say this is what we start to see as we break out to the bottom of that range. Let's just say. Now, how do I identify trending environments? And what do I do to put myself in the right frame of mind before I trade in a trending environment? Well, I got to draw some trend lines. And so in this situation right now, I'm going to do 2 examples. One example of trend line support, and then one example of trend line resistance. We'll start with resistance, so it's a little bit easier to see. But what I'm going to do is I'm going to pull up my trend line tool, and I'm going to see if I can connect at least 3 points. Everyone has a different approach, but I want to see at least 3 points because to me, that's a valid trend. 2 touches, I can connect 2 tops of candles, 2 bottoms, like anywhere on the charts. If I can connect 3 or more, that's a valid trend. And so what I see right now is if I go from this high right here, I can connect this high, and even this high. Check this out. It's actually pretty crazy. I have 4 touches to this trend, actually almost 5. 1, 2, 3, 4/5 or 5, if you want to call that one touch, because it was kind of close together, but that was 2 attempts, different weeks, so technically 5. That, my friends, is a valid trend line. So now this is this is my base. Like I am basing now a trade off of this until it proves it breaks, it should be respected. And of course, there could be fake outs for sure. But until this proves to me that it's going to break, I like this. So now when the market comes up towards this trend line, I'll be cautious. But if it gets up here and then it starts to kind of roll over, well, now I can take a trade to the short side and I know my risk. My risk is right there, dialed in. So now I have a base. So now, okay, the closer we get to this line, the better my risk reward becomes for potentially playing the downside and having that trend continue until it breaks. Now, when these trends break, my goodness, we can see some big moves to the upside. So keep that in mind. Or downtrends break, big moves up, and when uptrends break, big moves down, like we're about to see here in just 1 second. So we're trying to connect at least 3 tops of candles for a trend line resistance. I'm not a humongous fan of downtrending support in a sense. That's more so a channel, and also you'll find that I have found that it's not as reliable. So I like to use trend lines in terms of resistance or support, and my resistance trend lines tend to be the upper bound. So they tend to be the tops of candles to the downside, and then support uptrends tend to be bottoms of candles to the upside, sloping up, okay? So there's our first piece. If I zoom this in the past like couple of months, what am I going to notice? Not perfect, because we have this kind of wonky candle right here, that low right there. But what I can do is I can actually draw in a nice uptrend on this chart. And what do I see? Well, I have multiple touches here again. So if we count this area, that's roughly 1, 2, almost 3 touches there, or there's a third touch there, and then a couple touches right up in here. So what I'm seeing is uptrending higher lows, multiple touches to this trend line. I can put a support line underneath. It has an upward slope. That is an uptrending support. That is our area that if it breaks, we're looking for a big move down, and it did. And guess what? We got a nice move to the downside. Now we're in consolidation phase, but we got a nice couple of day move to the downside. Nice candlestick move there. And that, my friends, is identifying trends, support and resistance in trending environments. Now there's one more thing that I do want to mention. And what I'm going to do is I'm going to mark my charts a bit more here with this next, I guess, technique or form of technical analysis. And I want to look at swing highs and swing lows. So you might think, okay, what the heck does that mean? Well, I'm going to look at these charts and I'm going to draw in horizontal lines at relative highs and lows. Now, can I draw in, multiple touches to that horizontal line? Probably not. But the reason why I'm going to do that is because they were influential key levels where we saw big reversals in price. And so those levels should be utilized in the future to gauge or to potentially watch for a big move, watch for a resistance rejection, watch for a support bounce if we retest those levels in the future. So the highs of my chart, I'm going to mark. I'm going to also mark some of these relative highs on the way down. Now, of course, we had that trend line that connected a lot of these, but I'm going to mark these relative highs on the way down, as these are also areas that we can watch for resistance. And I'm going to also mark all of these lows to the downside as well, or at least a bunch of these lows that we had on the way down. So as I start marking these levels, you can start to see that some of them might have more value going forward or have had some more value, some might not. Now, it's funny that this level right here that we just rejected on the S&P ended up also being pretty much a level right here we rejected, acted as support back in here, acted as an area of consolidation right here, and actually almost was a support right here. So these levels, there is similarity. And again, support turns resistance and resistance turns support once they are broken. So keep that in mind and keep that as, again, it's no guarantees, just like anything else, but it's a great base to kind of go off of. And then you can frame, the next piece from there. So we have now key levels. We talked about support resistance. Let's now talk about supply and demand. Before we get to patterns, let's talk supply and demand. Now, here is where I love charting, and I love utilizing the tools on TradingView. I'm going to utilize the rotating rectangle tool. You might think, what? It's essentially a line. I love this tool because things are not perfect. Things are not always perfect. And so in this situation, what I see is I'm going to draw this from the highs down to where we just rejected again, right? And if I was to draw that perfect line, is it perfect? No, it's just not perfect. You're going to have a slight miss. If I just drew that in, I zoom in. We didn't quite touch the line there. We actually kind of broke it a little bit higher there. It's not perfect. And so this is where we can eliminate some of the error. And that is what I love about supply and demand. So again, I draw that line again. Now I can give this a bit of a width. And so now I can draw this in, and it really, I wish I had a specific strict rule to give you, because I know that's what people want, but that's just the nature of trading. The market doesn't provide strict rules. This is now my zone. This is going to eliminate some of the error if we come up and test this area again in the future. This is going to eliminate some of the potential error that I might mentally have if I was looking for a specific point of a rejection, a dollar amount to the cent or to the 25 cent or to the whole dollar. It's very easy to get faked out when you're playing that tight in terms of your risk management. So I love using a downtrending range versus just a line. Now, back to that 5-minute chart that we were talking about earlier on the S&P. Why we like to use supply and demand instead of support resistance is this exact reason right here. Because there's going to be error. There's going to be a range. We're not going to be able to hit the exact dollar amount to the cent as resistance, then fall back off. So what I'm noticing here is that this area is an area of supply. Now what's supply and what's demand? It is actually quite similar to the actual definitions of supply and demand. In this case, this is supply because sellers are taking over and there's too much stock, let's just say S&P stock, for the amount of buyers in this zone. There are just not enough buyers to send it higher. It's just not happening. So we have supply. And then what we have is demand on the downside. And that's where, for example, we can zoom in even further. These can be zoomed into different time frames too. This was an intraday setup where we had demand down here. And there was too many buyers and not enough sellers to send us lower. And so buyers stepped in and we bounced to the upside. So what we think about supply and demand, what we're looking at, and I can draw a few more boxes in here as well. What we're looking at is we're looking at support resistance, but we're essentially allowing for some error. We're not looking at support resistance and putting a line through it. We're allowing for some error on our charts, which is what I think is super, super fun, because now we don't have to be super, super strict and super, super tight. Okay, we can give things a bit. We can give some room, and our position sizing should be made accordingly. If I am looking at playing S&P or I'm playing futures, right, and I'm sizing in with, let's say my average size is 5 contracts on futures. If I'm going to have a bigger downside risk because of my zones, I'm going to probably have a bigger upside target, most likely. I need to make sure I'm sized accordingly. Maybe it means my sizing has to get cut in half versus what I'm used to because I was more of a scalper. And it depends on the time frame and the sizing, but really, when you start utilizing supply and demand, I think you're going to notice that you're going to get stopped out on trades a lot less, and it gives you more opportunity and more time for that trade to work, okay? As I zoom this one in here, and I see if we can pull this supply demand, or this supplies, or this demand zone, this area right here. What is this? Look at all these candlesticks coming down and bouncing off the same zone. It's not the exact dollar amount to the cent, but it's roughly the same zone, give or take a few bucks, or in this case, from the bottom here, it's around 39.10, and the top of this that I drew is around 39.50 on the S&P. So about 40 bucks zone on the S&P, which is almost a $4,000 stock, essentially. It's not that much, realistically. It's a tiny percentage. Actually, if we do the math, that's about 1%. Yeah, about 1%. And the move that we had off of these supply zones, what have we seen? 3 to 4% move to the top of the range. Okay, so if you're going to potentially take entry points inside of here and risk 0.75, a 0.5%, and your upside is 1 to 2, sometimes even more, 3, that risk reward to me looks pretty good. And we're using supply and demand instead of having to use a specific point and have the risk and run the risk of getting stopped out on a quick, wick to the downside, a quick move that gets bought up, and a fake out, essentially. So supply and demand can help avoid getting caught in some fake outs. So hopefully that makes some sense in terms of supply and demand. We're really just taking support, resistance, and we're adding some error to that. And we're understanding that this is how the market tends to move. It's not perfect. It's not always super pretty, but it generally works. And this could be a very, very good framework to base your trading off of. So now let's cover some patterns. When it comes to the stock market, there are a million different patterns that you can choose from. I'm obviously not going to be able to cover all the patterns because that's just quite impossible. But what we're going to do is we're going to head over to finviz.com. And the reason why is because Finviz is going to supply us with a lot of patterns that we could potentially trade off of or use to potentially trade off of in the future. So I'm going to go to the screener tab. Okay. And what I'm going to do here is I'm going to go down and I'm going to go to market cap. If I like trading large cap stocks, then I'm going to go to large cap stocks. So I'm going to go to plus large, over a $10 billion market cap or higher. Then what I'm going to do is I'm going to go to the technical tab and I'm going to go to where it says pattern. So you see how this is awesome. This is free. There's also a video that should be up on the channel already. If not, it's coming out very, very soon, where we cover a complete Finviz tutorial for the free version. Like, highly recommend you check it out. Now I scroll down and I can find trendline resistance, trendline support, wedge, triangle ascending, descending, all of these different things. These are a ton of patterns to play off of. We're going to cover a couple, and then we're going to dive into trading plans and how to build trading plans based off of things like this and our trend lines, which we've kind of honestly already touched on a little bit going forward. Let's talk about the wedge. So there could be wedges in many, many, many different forms, but let's look at a wedge up that is strong. So what you're going to do is you're going to do that, and any other customizations that you want to make on this, you can do. Then you're going to look over here, and there's going to be a bunch of different stocks you can watch, okay? So I might click on the first stock here, okay? AJG. What I'm seeing is Finviz's interpretation of a wedge, and what they're going to do and what a wedge really is. So I'll just go back to this chart right here. What a wedge really is it could come in any form. It could be uptrending, downtrending, could have an upward point or a downward point to the wedge. We're looking for price action to start to really tighten up. So it could be like this, to some degree with more of a point to it, but it's tightening up. And what we're looking for is a break up or a break down out of that wedge. That's what we're looking for. And what we tend to see is that descending wedges that point to the downside, we tend to see some more powerful breaks to the upside. And when we see ascending wedges or wedges that are formed to the upside, potentially some more powerful breaks to the downside. So if we have price action that looks like this, break the wedge here, we've seen time and time again some big moves to the downside. Now, of course, doesn't have to happen. Doesn't have to happen. So don't use a wedge and say, oh, this is going to break to the downside and I'm going to be great because I'm looking at an ascending wedge. No, the probability might be better there, but they could still break the upside and cause a little fake out squeeze or even a bigger move to the upside. So keep that in mind. But Finviz is going to kind of show me, in this case, is it perfect? By no means. But what we see is that wide-ranging price action is starting to tighten up. And it's coiling up, as we say. And as we get to the end of that spring, that coil, there can be an explosive move to come. So that's one example of what you have using a wedge to play price action. Okay, let's go back to our screener. Let's talk about head and shoulders. I'm going to go to a head and shoulders pattern. There's also an inverse head and shoulders, and then we'll talk about double tops, double bottoms. So for example, we're looking at a head and shoulders pattern potentially on one of these stocks. Let's look at AVY. So what Finviz is going to classify as a head and shoulders is a L right here for the left shoulder, an H, which I know it's right here for the head, and an R. Now, if I go back to my charts, we'll show you Tesla in 1 second to give you a better feel for this. But a head and shoulders pattern is like this, okay? Essentially, it's something like that. And our neckline is down here. And what we're looking for is this shoulder and this shoulder to be below the head, and a break to the downside under some sort of support or neckline that could be uptrending or it could just be horizontal, tends to yield big time moves to the downside. And a head and shoulders pattern is a very common topping pattern or reversal after a big move up to a big move down pattern. That's what you're looking for. The exact opposite on an inverse head and shoulders, where you're going to have, let's say, a lower low. I'm not sure why I'm making them out. I think it'd be points. A lower low, and then or a low, relative low, followed by a lower low, right? Followed by another relative low. And then what happens here is the break of this neckline would be a nice move up, and that would be a reversal pattern. So you're seeing, these two lows, not as low as this one, and this one is a higher low, indicates a reversal to the upside. Boom, we're looking for that break, okay? So in Tesla's case, TSLA, check this out. If I get rid of some of this stuff, let me get rid of some of these zones or some of these markings on the chart. What do we kind of see? It's not perfect, but what we're noticing right now is this. We had this relative high, we had this high, and then we had this relative high. You can even count this one here. But what we essentially got was a relative high, a higher high, and then a lower high. All you're looking for is a lower high or a higher low off of a pretty extensive move up or down. And then those lower lows held on, Tesla trending down, and now it's breaking down the neckline under in here. It's really kind of flushing. And you saw how big of a move we just saw to the downside now on Tesla as of late. So that's a great example of utilizing this invert or this head and shoulders. If you look at DIA, this is kind of like the Dow Jones ETF. You'll see that it's a similar situation right here. You kind of had this high right here. We had this level, and then we had these lower highs, to go off of this. It's not perfect, but you had, the looks of that head and shoulders, that ended up panning out, and you had that reversal to the downside. So that's a head and shoulders for you. That's what you need to pay attention to. Head and shoulders bearish, inverse head and shoulders bullish. Okay. Now double bottoms and double tops. Double bottoms, that's bullish, that's bounce, that's support at a double bottom, and double top is bearish resistance. So let's look at that. They're going to call, they have multiple top, multiple bottom, or they have a double. So I'm going to go to double top first. Let's talk about this. Autodesk. Boom, look at that. So you have a double top on this chart where you have these highs right here around 234, 235. Okay, back in August, September timeframe. Then you came up here and tested that again in November, and you couldn't go higher. That's your double top. You could even have called the double top from right back in here, back in literally just August, and we had a big move down. Double top, and that's what Finviz is classifying, and then that move down to follow. Let's look at for a double bottom. Double bottom, let's see if we find something good. Let's look at Ford. Ford is interesting. Yeah, look at that. Actually, multiple bottoms. Ford, every time Ford comes down to around $11, it's gone up, bounced again, and now it's actually sitting there again right now as we're filming, potentially looking to bounce. We got some nice reversal candles back to the upside. It's bouncing off $11. So there you guys have it. That's kind of an intro into patterns and trading patterns and utilizing patterns to identify potential setups and potential opportunities in the markets. Now let's talk about trading plans. So back our way into this whole thing. We are looking at charts. We've got directions dialed in. And now we're looking for patterns and then risk. Let's talk risk. Let's use the Dow. Let's just use this guy as a good example. So here's DIA. If I draw in my zone of supply, downtrending supply, what I'm going to find is that the Dow actually looks pretty juicy for something to the upside. So the Dow has tested this zone 1, 2, 3, almost 4 times, or pretty much 4 times. Now it broke it. So we had a downtrend that broke right here. It broke. What are we doing right now? Right now, we are in the retest mode. So we are in a period right now on the Dow that either what's going to happen is we're going to hold a prior resistance, now turn support and go higher, or this is a fake out. And we are going to break out up over this prior resistance, trap buyers who thought that, okay, it's time to go back up and it's time to buy again, trap buyers, and now potentially fall back off and go lower. That's what we're at. So if I'm looking at this, I can't assume any situation here. I cannot. Because if I let my bias take hold, my bias might tell me that I think that we're going to go lower. I think we're going to go lower. But based off of my charts, my analysis actually here tells me this is going to go higher, and it actually looks like a pretty good setup. Why? Because we had a downtrend break, okay? And now we're in the phase of retesting. And we've had now multiple candles, multiple days where the sellers had the chance to send it lower. They haven't been able to do so. Buyers are able to come in here and hold this afloat. So until that's invalidated, I actually might want to be long here. I might want to be long. So what I'm going to do is I'm going to put down a trade. And I'm going to enter a trade. I'm going to use the TradingView kind of trade position tools and enter a long. Let's say I enter a long right here. Where's my stop loss going to be? I'm going to put my stop loss just below the lows of these recent candlesticks. So that's going to be around this 325. Now, when it comes down to it, this is not going to be a super dialed in video on where to put your stop loss. I like to use whole numbers. So if I find that this chart is sitting up at 325.70 is my support of these lows, I'm going to put that stop loss down to 325, just under 325 as a kind of like psychological area of support. And then I'm going to base my trade off of that. Now, here's where things get interesting. Okay? Because if I back my way into this, right, into this trade, here we are. And this is a 2.3 to 1 risk reward. I'm going to move this top end down to a 2.0 on that risk reward. What does that mean? This means that I'm going to risk essentially $1 of downside to make $2 of upside in this situation. Okay? That's what my risk reward ratio is telling me. And I love using TradingView for that because it makes it super easy to identify. And it's like, does this trade make sense? Is my risk reward skewed to the upside? You don't need to have a 2 to 1. You could look for 3 to 1. You could look for 1 to 1. You can look for less. What it comes down to is your win rate and your past. So if you know that you win 60% of the time, which is actually great. Like if you win 60% of the time, and on top of that, you keep your losses smaller than your wins, you're doing great. Like that's awesome. Okay, your biggest risk is a blow up. Your biggest risk is not respecting those rules. If you win 80% of the time, then you could bring that risk reward to a 1 to 1 or even potentially lower. It's fine. It just comes down to where that sweet spot is for you and your trading. And that comes down to back testing and trial and error, whether it's paper trading. Got some videos on how to do that on TradingView, other platforms, or whether it's just putting some money to the test, small amount of shares or small amount of contracts, whatever you're going to do, small size, and testing it out and tracking your progress and seeing what patterns work, what's not working, doubling down on what works, cutting out what doesn't work for you, and increasing and improving your strategies from there. That's what it's all about. So when it comes down to it, to me, as someone who likes to use like a rough 2 to 1, this makes sense. So do I care that this bias, the general bias in the market right now is that we're going to go lower? Do I care? No. I do not care because the charts tell me this. And if I'm wrong, that's fine. Trading is not investing, as investing is not trading. When you're investing, you're looking for undervalued companies, or you're looking to dollar cost average and take advantage of the fear, right? And you're buying stuff, you're buying into the US markets, you're buying into companies that are going to be here for a long time that you believe will grow, right? Trading, you cannot allow an investing approach and mindset, which most people come from because it's very easy to grasp. You come from that mindset of, just, slowly accumulate more assets, more shares, more of this over time. And as time goes on, everything goes up because the markets just generally go up. Yeah, you can have 10 years maybe where the markets trade sideways or actually go down. But on year 20 from, let's say today, we could be way, way higher. And if you kept, accumulating shares, that whole time, maybe they were down for the past 10 years, 20 years later, they're going to be up a lot. And now you're going to, finally be reaping the rewards of your buys. That's fine. That's not trading though. You can't wait 20 years, right, for the stock to come back up. You have to respect your risk based off of patterns, based off support resistance. And if a pattern support resistance, supply demand, a trend line, or the double bottoms we talked about, the head and shoulders. If that invalidates, you get out. And you make sure that that invalidation point where you're going to get out because it's no longer valid, that risk is less or the same or whatever it needs to be compared to the reward, the target of the trade, so that you can win at your win rate and still make money in the long run. Because it's not a trade to trade game. It's over the course of 20, 30, 40, 50 trades. Are you winning? Is your account going up? It's not about this specific trade. So hopefully that makes some sense, and that gives you kind of a piece into trading psychology more so than even just technical analysis. But I think they kind of go hand in hand when it comes to actually executing your trades. So if this helps, highly recommend you share it with a friend, hit the thumbs up button, save this video, make sure you subscribe here. We post 1 or 2 times per week on this channel. And we try to make videos like this that are helpful and give you guys a great free resource to refer back to. Again, just like anything else, you got to figure out your own stuff. This is a great place to start, but you're not going to see things how I see things, and just as I'm not going to see it how you're going to see it. So it comes down to applying what you're going to learn here and elsewhere, and applying it to your own strategy and working from there. There's no perfect indicator. There's no magic indicator. There's no magic strategy. There's no magic pattern, right, that anyone's going to give you. There's no magic alert system. There's no magic, Discord that's going to be the key to your success. You can learn a lot of things from these different kind of avenues, but what comes down to actually applying it yourself. So the platform we're using here is TradingView. We'll leave a link to TradingView down below in the video description box. There's other links, resources. There's also a webinar that we covered, like 3 trading signals, plus a bonus to add to your arsenal if you want to check that out, other brokers to use. Those will all be linked up down below. Make sure you subscribe, thumbs up button, and I'll see you guys in the next one. Happy trading.